Welcome back guys to another video. So as you have seen probably, we have seen quite a drop in the price recently, and some people say it's a recession, it's a big market correction. Well, let's have a look actually. And as you can see, this is the S&P 500. It just shows the market overall, how the market has reacted. And yes, we have seen a drop recently. This what does it mean? Well, let's see historically. This chart might explain whether or not we have actually a crash coming. And this is the federal funds rate. It's essentially the interest rate that banks charge each other. Let's say it's the interest rate in the market, okay? These gray areas are where we had recessions in the past. This is the dot-com bubble, this is the 2008 recession, this is COVID, and what do we have now? Let's see. Well, what do they all have in common? What they all have in common is they have a peak in the interest rate, and a few months after the peak, there is always a crash. So they all have this in common every single time, and we're seeing it now again. We have the interest rate peaked and it has started going down, just as in 2020, just as in 2008, and just as in 2001. Well, what does it mean? With a high likelihood, according to this chart, we might see another recession. And you can see it here. This is 2020, this is the COVID crash. It did actually not correct that much, but you see every time after the crash, it has gone up a lot. The price has gone up by a lot. This is 2008. The price has gone down, and then the markets have corrected very heavily, and therefore, why would it not happen again? We're seeing a correction now. Sure, it might go a bit lower, but eventually it will go back up. So whenever there's a crash in the market, this is a very good time to buy. Now, let me just explain briefly, why does a drop in the interest rate indicate a potential market correction? Well, what the central banks do is they lower the interest rate to make borrowing money more accessible for people, right? So if they lower the interest rate, it's cheaper to borrow money, and this way they stimulate the economy. If businesses can now take out loans with lower interest rates, and this extra money will go into the economy to stimulate it and to prevent further crashes. And central banks do this to essentially help the economy, to make the crash not as impactful on the economy. And it's a good indicator that maybe something is going wrong, because what central banks try to do is keep the inflation at around 2% per year, and they do this by adjusting their interest rates. So looking at this chart, and we've seen it already starting, we might have a correction, and it looks like we do, but there's nothing to worry, because eventually if you invest long term, the markets do always correct. And therefore guys, this might be a good time to buy some assets soon.